Module 1A Part 1 Valuation Modeling. Introduction. Hello and welcome to the lesson on valuation modeling of the financial course by Simplilearn. This lesson is about valuation modeling. Valuation modeling is the study of the basic elements used for financial modeling and financial analysis. It is an introductory path to business valuation models and advanced models based on sophisticated projections in probabilistic environments. The presentation we will go over today should give you a broad overview of the important aspects of valuation modeling with some concrete practical examples. Now, let's move on to our agenda. Understanding integrated financial models. We will start our presentation with a discussion on basic valuation techniques. There are three types of primary sources that we can use when trying to give a value to a business. The first source is the past financial performance. This means, for example, the revenues from sales in the recent years, the level of profit when related to sales, the capacity to serve debt interest, and so on. The second source of information is the current structure of the company's balance sheet. This informs us of the key financial ratios that can provide a quick diagnosis on the company's financial health. Finally, the current structure of the cash flows enables us to relate the value of the business to how it is expected to continue during its business. Let's now move on to the next slide and analyze each aspect in more detail. Let's look in more detail at the analysis of past financial performance. The main aspects we are interested in when looking at the history of a business are the following: profitability, solvency, leverage, turnover level, and cash flows. Profitability tells us whether a company has been generating profit historically. A company that generates profit is, other things being equal, more valuable than a company that is not. Equity holders expect a return on their investment and will pay more for a company that provides them with a good return on capital. Profitability is a key concept in company valuation because everything is driven by profit. Profit is the number one reason why a company was created in the first place, to try and create profit. We're not saying that profit seeking is the only driving force between companies and the people creating companies, but every business is trying to create profit. When a business does not produce profit, which means that it loses money, one can infer that something is wrong, even if it is only temporary bad economic climate. The absence of profit makes companies less attractive and therefore less valuable. Let us go to our next slide, where we continue to explore the main aspects of relevance in past performance. Solvency is our next topic. Solvency related to the capacity of a business to endure tough environments. A solvent company usually holds enough capital to be able to suffer some losses or a severe reduction in its net asset value, called NAV. So the concept of solvency is very close to the concept of strength or resilience. It is a capacity of a company to absorb unpredicted shocks and difficult situations. Leverage, which is the ratio between the asset's value and the equity value, is the next aspect that we want to look at when analyzing past performance. Leverage relates to the relative scale of equity compared to liabilities. It can also be looked at in terms of the ratio between assets and liabilities given the fundamental accounting principle that assets equal liabilities plus equity. Here is a simple example to understand the role of leverage. Assume we create a company today with a capital of £1 and borrow £99 from a bank, assuming the bank will accept. We will therefore have £100 worth of cash that we can invest in various assets. Here the risk of default of our company will not be the result of the large leverage, but the result of how we decide to invest this cash. If we buy risky assets and create the risk that we may not be able to pay debt interest, then we have created a solvency problem. If we invest the £100 into a risk-free bond paying 10%, whereas our interest on debt is only 5%, then our company bears virtually no risk despite having a 100-to-1 leverage ratio. Let's continue our discussion on the next slide. Turnover level is the next aspect that we want to investigate in relation to past financial performance. Despite being very useful, the turnover level is a very misleading piece of information. On a fundamental level, a large turnover is good as it means the company is selling. Yes, selling is not everything, because selling is somewhat pointless if no profit is generated. Anybody can do that indeed. What we need to understand is that turnover levels in isolation are not a good measure of profitability. The turnover is a measure of activity. Cash flow is the last aspect of historical performance that is of interest. Cash flow management is a very important part of company's life because money flows in and out on a regular basis, and a company must adopt a cash flow management strategy that allows financial stability and safety while not being overly safe in order to allow some cash to be redirected to business growth, as opposed to making the business more secure financially. Balance activity level and financial safety is an art. Let's now move on to our next slide, where we discuss a new topic. The value of a company has two main aspects. The first aspect is the proven track record, some which can be measured by looking at the historical performance, as we saw in the previous slides. The second aspect of value is potential. If we were to group companies into two different categories, the first group would be companies with established mature business and proven track record of stable profit but limited growth. And in the second group, we would have companies that do not make a profit yet, but have a large potential. Value is an immediate component related to existing profitability, as well as a company relating to potential. Potential is a lot of different things put together, but mostly it is the possibility for a company to transform customers into profit. Through the telecom age in the late 90s and early 2000s, we saw this new business model of companies with large amounts of debt used to create massive client bases before any profit was generated. Most of the value given to these companies was the result of their potential to turn this large client basis into profit. Let's try to compare those two aspects of value. Immediate profitability is relatively easy to measure compared to potential. When a business generates profit, there is data to use and extrapolate past profit patterns into the future and try to infer what the corresponding present value of the future profits is. Unlike proven profitability, potential is vague and difficult to measure. Assume that a company provides a huge number of clients with free phones and monthly phone subscriptions. How do we measure the potential profit that could result from the company's ability to conceive people to start paying for the service? This is tricky, and any valuation would only be a model relying on several assumptions. Business with potential only are businesses investing money in the hope that the investment in research, marketing, etc. will generate profit sometime in the future, enough profit to make the risk worthwhile. It is important to understand that materializing profit potential is difficult and requires companies to rely on debt and private investment. Those important levels of risk can end up sinking a business when the potential fails to be materialized. One measure followed by analysts and relating to our discussion about potential versus immediate profit is the price-earning ratio, PE, or sometimes called PER. It is the ratio of stock market value to the annual earnings per share. If the stock market price is $100 and the annual earnings per share is $2, then the PE is $100 divided by $2, which is equal to 50. The PE provides with a measure of how expensive a company is. For companies making very little profit or even a loss, the PE can reach either very large numbers or worse, negative values showing that the profit is a loss. This is what we say during the early 2000s with many telecom companies. Let's move on to our next slide.